What's up? Welcome back. Today, we are going to talk about private credit. Private credit's been in the news so much in the last month, has it been? Maybe even like a little bit more than a month. I feel like it's every other headline that I'm seeing about private credit. And so we wanted to talk about just where it's at, kind of the state of the marketplace and the things that we're seeing on our side. Today is March 20th. It's Friday. It's about 10 o'clock in the morning. And we've got a full breakdown for you all today. How's it going?
Good. Other than the market just selling off as well. So
market's selling off.
Not just private credit.
No. Yeah, what's the market not like this week? Let's spend a minute there.
Oil. That's really been the story. And again, we can harp on what is causing the price of oil to jump from $67 a barrel to right now at $99 a barrel. But yeah, that's really been the story because that's pushing headline inflation. That's going to push headline inflation, which is going to cause the Fed to pause any rate cuts. Right? That's basically what the market's pricing in, is like throw any rate cut assumptions out of the window for this year.
So we can blame Jerome Powell then, right? Because he came out and he said, "I'm staying and I'm not cutting."
Yeah, I'm not leaving.
I'm not leaving.
Yeah,
Deal
so
with it.
Jerome Powell is currently under investigation over this remodel of the Fed building, which, again, government buildings are, brought up to date. Apparently, the administration doesn't like that, and that is causing other senators to delay their confirmation of the incoming Fed chair, Kevin Warsh, until this is resolved. So Jerome Powell is saying he's not leaving until this is all set.
Okay, interesting. All right. Well, yeah, I mean, that won't be done in the next, 2 months when the chair is supposed to turn over. So, yeah.
Yeah,
we'll see.
it's supposed to turn over in May, so a month and a half at this point.
Yeah. All right. All right. Let's get to the meat of it. So, private credit. I have to say that private credit has been, before all this news hit, it was like every day I would get an email, so just speaking from the advisory side, right?
Yeah.
We would get emails every day from a new private credit fund, like new fund launched this, and here's what
this is the yield.
And this is the yield, and it's, we just started it, right, type thing. And everybody had a private credit fund. And no question that the asset class has grown significantly since only a handful of years ago. And now, really in the last 30 days, it's the exact opposite. It's all the opinion pieces and everything about private credit falling apart and we're in a credit crisis and everything's going to blow up. And so man, what an interesting, turn of events there. I'm no longer getting, here's our private credit fund, will you put it in your portfolios? I'm getting, these opinion pieces on why it's blowing up. So we wanted to just talk about this more here on today's podcast, talk about what's going on and also what we're seeing currently in the numbers.
Yeah.
And just try to give you all an objective update of the private credit markets. So what is private credit? Let's start there. What is the asset class?
Yeah, let's kind of set up the function, right? The role that it fills is it's lending money, right? The name, as the name suggests, is you're privately lending out money to private bank companies who, one, aren't big enough to do a bond offering, or two, too big for other regional, traditional banks to loan money to, because that over time has been something that's been eroding, that banks who used to lend out to businesses no longer lend out to businesses at the same rate that they used to be.
Yeah, so private credit, where companies will feel that it's more attractive than going to a big bank is that typically it's a faster way to get capital and a more customized way to get capital. So each loan is individually underwritten, and because of the relationships that these private credit lenders have with companies and frankly, private equity backed firms, so they have relationships with PE firms, they can put together a loan relatively quickly and complete that underwriting process. And so
Yeah.
kind of that speed is attractive. Yeah.
And cash is king for any business, and it's an important piece for keeping businesses going, right? Especially startups. So, again, it's a really important piece of the economy.
Yeah, and this really, private credit's been around for many, many years. This is not a new invention, but it started to grow quite a bit after the financial crisis. So sort of the 2007, 2008 time frame when banks had some additional regulation put on them to make lending standards higher and lending go slower, and even syndication requirements, meaning if your loan is too big, it has to be spread across multiple banks, and banks then do that to spread their risk. Insert private credit, because private credit is not a bank, and the amount of dollars that are in that space has been growing really ever since that time frame.
The big distinction between the two, though, you put your money in a checking account, they lend money out to a mortgage, but you want your money back from your checking account. That's one mismatch that a bank can't really do for you, right? But private credit, you're an investor knowing that that money's going to be used to loan out money. Very big distinction there.
So such a great example, because let's think back to Silicon Valley Bank, right? Which is a bank that failed. And let's set aside for a minute if there's opinions that, okay, the bank didn't invest capital correctly or not or whatever. What happened there was a run on the bank. And so when the bank lost all their deposits, they had to then sell kind of short to medium term investments to get cash to then continue to meet those outflows from the ATM.
Yeah.
The wires out, right? Well, the problem is interest rates in 2022 shot up, and those investments that they made were worth significantly less, just with how interest rates play with bond prices. And they were liquidating at losses, and ultimately, didn't have enough cash to send their investors, and boom, bank failed, sold to JP Morgan, who could blend it away in 5 seconds.
Yeah. The run got worse, though, too. Quick interjection, but the run got worse because that's an enclosed, ecosystem where tech bros are talking to other tech bros, get your money out before you can't get your money out. Some guys with podcasts were saying, get your money out now, which accelerated the run.
Yeah. So, yes. And what's different here is that private credit comes with gates. And so many of these funds have a very standard clause in them that say, at a maximum, we will only liquidate 5% of the fund, or honor redemptions worth 5% of the fund quarterly. And if redemptions are higher than that, let's say that they're 10%, it's up to the fund's discretion on if they will actually honor all of those distributions or if they will cap it at 5%. And that's a really good fundamental distinction, because this has happened over time where people want their money from certain private assets, and the assets behind the scenes here of these funds aren't that liquid. It's like you can't just sell a building in 5 days. You can't just take your money out of a loan in 2 seconds. You can't get your equity out of a PE-backed company that doesn't actually have a monetary value on their equity yet, right?
Yeah, or a buyer on the other end to unload the shares, right?
And it'd be sold at a discount, right? All these things are issues, exactly. So good point. It's fundamentally different from an asset class, and that gating effect, I think, is probably one of the things that's helped the asset class be actually quite stable over a lot of years, including multiple market drawdowns.
Yeah, what Chris was referring to is back to the 70s. This stuff existed, but mostly owned by pension funds, wealth funds, endowments, and insurance companies.
Yeah, and more recently, really in the last number of years, has become more available to kind of the normal investor with lower minimums and greater access to these funds, instead of many millions to get into a fund, and even a $250,000 minimum. So these days, a lot of the funds have quite low minimums to get into, which then allows kind of a normal investor to get access to the asset class.
Yeah, and I think that's where the problems start to bubble, is those pension funds are not a mom and pop retail investor, and they have very different investment goals and horizons. And if you're not setting this up properly, that's when the latter gets into trouble, because illiquid means illiquid, or semi-illiquid means roughly illiquid, whatever however you want to package it. Because Chris is hypothetical about a building. If me and him went in business and bought a building and he wants to sell 2 years later, that's not fair to me. Because that means we have to sell the building most likely at a discount so Chris can get his money back. That's what pensions understand, is they size these investments so they don't have to touch it for decades, right? They're just taking the income off of it versus the growth of, I don't know, the retail access has gotten so big that we are admittedly seeing a lot of like new shops spring up that we know have no access to great loans. They're just looking to collect a higher fee versus the ones that have been doing this for decades. And that, I think that's where the distinction should be made.
Yep.
Where are you chasing after a 20% yield? Because I've seen an advertisement hit my email that way. That shouldn't pass any kind of regulatory hurdle, but it does in this private space. And that's where I think retail investors get in trouble. They see the yield and they just jump on it.
Yeah. We've had no defaults in 6 months.
Yeah, because your fund was only open 5 months, right?
Yeah, because your fund, exactly. So good distinction. So no question that the amount of capital has come into this space has started to balloon in the last number of years, and no question that then that has led to the money has to find a home in order to create these returns, and that has then led to the lowering of the underwriting standards. And so I think it becomes very, very difficult for investors to figure out, okay, this fund is maintaining their standards. You know, they're still having strict underwriting. They still have very strong covenants in the loans, and covenants, just so everybody understands. So the way that these loans, I guess I'll say, should be issued is in the senior secured space, which means the loan has a claim on the company. So if the company can't pay the loan back, that company ultimately becomes the asset that backs the loan. Yeah. This is similar to how, say, your house is your collateral on your mortgage. Bank takes the house, bank sells the house, pays himself back, right? And so when you have that type of a feature, the loan becomes at least a little bit less risky. I'm not saying it's low risk. It's less risky because you have these covenants on the assets of the company. Now, those assets of the company might not be worth anything, but there is a claim on them that ultimately, you know, could be sold. And over the course of history, as we've seen defaults, because, you know, no question, the asset class hasn't had absolutely zero defaults in a ton of years.
That would be ridiculous to assume, right? Because
there's
you're
always
lending money
defaults.
to people. Yeah.
You
lend money to 1,000 people, 10 of them don't pay you back. You're probably still okay. But
exactly.
Again, I think that's what the financial media is really honing in on, because that's the news, right? BlackRock had 2 high-profile defaults, but how many hundreds of loans have they put out there? And I think that's what's missing in a lot of these headlines and these scary moments is what percentage. Again, the percentage is going to be higher than a investment-grade bond because these companies generally are unrated. They're just so young, or they're so private that there's no rating on them because there's no publicly available information on their books.
Yep. Okay, I want to talk about the issues here. So what is being zeroed in is the biggest issues within private credit is that the asset class alone, but many managers focus on software. So software can be 20, 30% or more of some funds. And the reason why that is that software historically has been an asset-light business and a very low default business. And so a lot of these lenders will loan to that. I guess I would also say the other reason is that there's just a lot of software startups, right? How many startups are there that are making actual products, you know, robotics and kinds of things, right? There are those too, but there's a ton of software startups. And so many of these are, you know, software first, things like professional services, healthcare services, those types of things. And so those services ultimately lend into software. And guess what's been selling off the public markets in the last number of weeks because of the fear on, is software going to be around anymore?
Yeah. The assumption is AI is going to eat all of those, I guess, those intellectual property, so to speak, or those offerings that these software companies have is just, well, I'll just put my H&R block into Claude and there I go. which I think is a big leap there.
It's two things. So it's A, the revenue model won't be the same because per seat doesn't make any more sense. So
Correct.
that's where you've got a lot of these companies, like from a big scale, say Salesforce and Microsoft. Microsoft are billed on a per seat basis. But what if we can't bill on per seat anymore because there are fewer seats, or there's one seat and then there's 100 AI agents that one seat is running, right? How do we bill? So our monetization models is now starting to shrink. And then the second thing is, of these companies, what can I program in Claude or ChatGPT in 5 seconds? And so you've seen in the public markets, companies like Monday.com or Atlassian, these companies have been sold off really, really hard because the market is saying, do you have a product anymore? So you will see if that kind of bounces back as we get more earnings report and whatnot. But right in the crosshairs of all this is private credit, because private credit will loan to these software companies and services companies that have software that ultimately have this recurring revenue model per seat. And those are the two fundamental questions: is even if you have a claim on the assets of this company, like I previously explained, is the company going to be worth literally anything to then pay yourself back? And then the second order effect is, if the company's worth something, what's your revenue model look like if you aren't on a per seat basis anymore? How are you monetizing? So those are the two things that are kind of freaking out the markets right now in private credit.
And that second one, though, keep in mind, these loans are roughly 3 to 4 years in maturity. So if you, as a company, can hold on for that amount of time and you can still pay, there's a lot of turnover in these portfolios. So you can just naturally allow these to mature. But these companies still need cash, right? I think there's going to be a marketplace for this, but will it be driven by retail? I doubt it. Maybe until the next cycle, but again, I doubt retail has much of an appetite to funnel new investment here.
So I want to talk about that in a second. I want to make one more point here that is a next order effect. So many of these funds, because they've been so historically consistent with their returns and have quite low defaults, and because banks don't really fit the seat of private credit anymore, what they do is they take loans from banks. So let's imagine, XYZ let's say Blackstone, hypothetically, right? So let's say Blackstone goes to Chase and they say, hey, we have this portfolio that's been incredibly consistent. Will you loan us money? And so then they do, right? So Chase says, great, we can kind of indirectly get exposure to this private credit space, but we aren't having to do the underwriting and do all the stuff. And so these funds will often carry some leverage inside of them. So that means if it's a $10 billion fund, maybe they have $5 billion of their own cash in it through investors, but then the other $5 billion is from, say, a bank that's lending money, right? These are all just examples just to paint this. This isn't, I'm just trying to paint this. So the second order effect of this is, if we see an increase in defaults, and if, say, a software company isn't worth anything, the leverage on the fund is going to go up, because if I can't collect back that $1 billion loan,
you still have $5 billion in loans you got to pay back.
Exactly. Chase still needs their money back, right? And so then, boom, this starts to snowball a little bit. So that's really what's kind of causing this fear. And not to mention, these companies tend to lend to private equity-backed companies. If the debt has a problem, just imagine what's going on with the equity values. Okay, so shifting into just what the marketplace is seeing, and I think that a lot of this is coming from probably the retail side, because how, as you point out, institutional investors will tend to take a very, very long-term approach.
Yeah, and they've been through all kinds of cycles.
Exactly. And so they do their diligence on a manager, and CalPERS or some pension fund or whatever says, all right, we're going to put X dollars with this manager, and it's going to be this slice of our portfolio, and let's let it ride, right? So these are numbers that are in the news that we just saw. So Blackstone, they had 7.9% of their fund requested this last quarter, and they cap at 5%. And I'll come back to them in a minute. Cliffwater is a huge fund. They had 14% of their fund requested. They gated it at 7, which is their disclosed max, and they said come back for the next 7. BlackRock had a 9.3% request. They gated it at 5%. Morgan Stanley's fund had a 10.9% request. They gated it at 5%. And Blue Owl, which is kind of I feel like the first one in the news about all this stuff. They actually, I think the data I'm looking at here is actually on their interval fund, so a little bit different. So I'll skip that one. So that's what's been going on in the news. There's been a spike in redemptions, and some have honored it and some have not.
Yep. So quickly, the issue with honoring all redemptions is you would have to sell all your loans at a steep discount when there's a marketplace where there's no buyers. So there's a dual effect happening where retail investors are a little impatient, right? And that's essentially what's happening. They're requesting their money back, which is forcing the funds to sell into the void, right? There's nothing to sell to. Ideally, you let the loans mature, and then you can get your principal back. But again, these are retail investors, and we're not talking about a more patient institution. Mm-hmm. So I think the remaining 93% in Cliffwater's case are suddenly put under pressure because that 7% wants to get their money back. Well, technically, that 14% wants to get their money back, which causes stress for the remaining investors, at least in the near term.
By the way, the public equity on these companies, if you look up Blackstone, KKR, Ares, all these public companies, absolutely demolished. Yeah, I mean, cut in half, which is just wild to see.
Yeah. So maybe the retail investors, at least at this scale, probably shouldn't have been let into the fund in the first place.
So,
this is through the advisor channels, but again, you don't have this rush for the exits when you don't have a full theater, right? Like that's an issue.
And I'm not saying the asset class is perfect or completely insulated to all the AI challenges that we just said, but man, what a problem that we bring in when you allow retail investors into an asset class, which has been the push over the last really 5, maybe 10 years, because those retail investors just don't have that long-term approach. They're the ones that run for the hills immediately. Yeah. And that causes these problems with these redemptions. So to your point, how hopefully the gates can kind of help that. And then hopefully we don't see
and over 2 or 3 years, there's an orderly exit or a wind down of the fund. That's actually pretty normal for the funds, how they normally operate. They do it through vintages. Yep. We'll open it up for a year to take money and then close the fund in 5 years when all the loans mature. Yeah. You got to let the loans mature. Like that's really the key.
I want to highlight Blackstone here, and then we'll get close here to our close. So Blackstone was in the news. They're one of the largest funds, the largest fund here. So they're the ones that had the 7.9% requested redemption. They gate at 5%, but they said, you know what, we're going to honor it as we always have. I believe they said 3 times in the entire history of the fund, redemptions have exceeded the 5% cap, and they always have met them. And so they came out really in what I would consider as kind of a vote of confidence in their own fund. They said, we're going to issue a 7% redemption, and the additional 0.9% was actually covered by employees. And so Blackstone's employees injected $400 million in new money into BCRED, which is their flagship fund. And that allowed them to meet all those redemptions. This says here via PitchBook, senior leaders contributed $150 million of that $400 million. More than 25 senior executives participated in the injection. And then they touted and they said the fund has $8 billion of available cash as of December 31. And on top of that, they still got inflows in the first quarter. They still had $2 billion of inflows come in. So I just wanted to call that out because they are still getting inflows. I think that's good news.
Yep.
But they're really trying to come out and say, hey, trying to cool the markets a little bit.
Yeah.
I don't know if that will work. We'll have to see next quarter. But ultimately, Blackstone is obviously saying, hey, we are confident in our fund and our underwriting. And, their executives are, putting money in too. So I think that was the best kind of press move that any of them could have done because it just shows sort of their commitment to it. But Anyway, I
Well,
just want to call that out.
the key, they're an established player. The last point is a lot of these new funds sprung up. I just can't imagine what those particular investors have gone through, because
Yeah.
they see really high yields and they jump on it, and this fund has zero history.
Yeah.
They're likely going to close up without giving the money back, which is pretty sad.
Yep. And like I mentioned earlier, those, the covenants changed in those funds. They don't have underwriting history. This is not an easy set up shop,
No.
start lending money, and you're going to be fine.
Yeah,
So-
again, maybe on the next part.
We'll keep unpacking this as we get more news on this. I think, the next thing is next quarter, right? Like, do we see what are called non-accruals, which is loans that aren't paying? Do we see them come up? They have come up a little bit. But
We're
they're still
talking about 0.3% though.
Yeah. They're still well below. Last I saw, they're still at half of long-term averages, and still well below, still well below those long-term issues. But they have ticked up, and so if we continue to see that tick up, we'll continue digging into this. But so we'll keep updating everybody as we get more information. But ultimately, that's our read. We just thought that was, hopefully that's helpful just to kind of unpack what I would assume has hit the news of all of you at this point. It's every day in my inbox, but it seems like any news outlet,
We're happy to talk about it though.
All right, everybody. We'll catch you again soon. Thanks for tuning in.